are a fundamental component of the financial landscape, playing a crucial role in both individual investment and broader economic activity. They represent as a debt instrument, where an issuer, typically a government or a corporation, borrows money from an investor and promises to repay the principal amount with an interest in a specific period of time. This presentation will delve into the mathematics behind bonds, its definition, types, examples, and significance in the financial world.
Good morning, everyone. Now we will discuss bonds. Let us first define what is bonds. Bonds are fundamental component of a financial landscape. It plays a crucial role in both individual investment options and broader economic activity. Instead of selling stocks, the company may also issue a bond. When a bond is issued, the company is borrowing money from the bondholder and promise to pay its face value and maturity date along with a given rate of interest called the coupon. When a company issues a bond, they are also considered as stocks. However, if a company declines bankruptcy, the bondholders have the first claim in the assets of the company before the stockholders. Changes in the prices of bonds vary according to the demands of the market or according to the market opportunities. Mr. Lanes, would you please define what is bond and how does that work?
A bond is essentially a loan that an investor makes to a borrower, typically a government or corporation. In exchange for lending their money, the investor receives regular interest payments, known as coupon payments, over the life of the bond. At the end of the bond's term or maturity date, the borrower repays the principal amount, also known as the face value or fair value to the investor. Bonds are often considered conservative investments because they offer a predictable stream of income and fix a maturity date. However, their value can fluctuate in the market based on the factors like interest rates and the issuer's creditworthiness.
Okay, thank you, Mr. Lanes. Bonds come with various forms and each with its unique characteristics and risk profiles. Now, let's explore the different types of bonds. Mr. Donny, please.
There are different kinds of bonds. The first one is government bonds. Issued by national governments, these bonds are generally considered very safe due to the government's ability to raise taxes to repay. It depends. Examples include treasury bonds issued by the U.S. government. The second one is corporate bonds, issued by companies to finance operations or expansions. These bonds carry higher risk than government bonds as the company financial health can impact its ability to repay. And the next one is municipal bonds, issued by state or local governments to fund projects like infrastructure or education. These bonds often offer tax advantage to investors.
How about the other bonds, Miss Primrose?
We also have short-term bonds. Bonds with a maturity date of less than 1 year. These bonds offer lower returns but are less sensitive to interest rate fluctuations. And long-term bonds. Bonds with a maturity date of more than 10 years. These bonds offer higher potential returns but are more susceptible to interest rate risk. And there have also inflation-protected bonds. These bonds adjust their principal value based on inflation, protecting investors from the erosion of purchasing power.
Thank you for that, Miss Primrose. How about the examples, Miss Audrey, for us to be able to understand more deeply about bonds?
Let's illustrate the concept of bonds with some real-world examples. The first one, U.S. Treasury bonds. The U.S. Treasury bonds issues bonds with various maturities, ranging from a few years to 30 years. These bonds are considered very safe and are often used as a benchmark for other bonds. Next one, we have corporate bonds. A company like Apple might issue bonds to raise money for a new product launch. These bonds would typically offer a higher interest rate than government bonds, reflecting a higher risk associated with the private companies. Last one, we have municipal bonds. A city might issue bonds to finance the construction of new schools. These bonds often offer tax-free interest payments, making them attractive to investors in high tax brackets.
Thank you so much, Miss Audrey. Therefore, the par value or the face value of a bond is the original amount of money borrowed by a particular company. Most of them issue a face value of 1,000 pesos. For example, a bond with a face value of 1,000 pesos has a 4% coupon and a 15-year maturity date. The interest is calculated using the simple interest formula. So, P is equal to 1,000 pesos, R is equal to 0.04, which is the 4%, and T is equal to 15, which is the time. So, I is equal to PRT. So, I is equal to 1,000 pesos times 0.04 times 15, which is 600 pesos. Therefore, the bondholder will receive the face value of 1,000 pesos plus 600 pesos for the interest. In conclusion, bonds are fundamental investment tool that allows investors to lend money to governments and corporations while earning a predictable stream of income. Understanding the mathematics behind bonds, including their definitions, types, and examples, is essential for making informed investment decisions. By carefully considering factors like maturity date, interest rate, and credit worthiness, investors can choose bonds that align with their risk tolerance and financial goals. Thank you, everyone.